makers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Kriti Gupta in London in for Francine Lacqua. Here's what's coming up on today's program. The pound falling as the UK's unexpected drop in inflation opens the prospect of a pause from the Bank of England tomorrow. Meanwhile, stateside, the Fed expected to take a breather on hikes for the second time this year, while leaving the door open to another increase as early as November. Plus, Europe's car sales jump. Brussels starts probing China's EV subsidies. More from our interview with European Commission President Ursula von der Leyen. That coming up on the program and more. Let's start with a quick look at where European markets are trading here, because again, we are in wait-and-see mode, just looking broadly at what the Federal Reserve is going to say, the BOE, and then, of course, the BOJ, not to mention the slew of other central bank decisions that we get later on in the week as well. But starting off right now, I want to say a little bit of caution. No real momentum, no real green on the screen, but enough to perhaps keep people a little bit optimistic. So you are seeing the outperformer right now, I believe, is the IBEX, if I can see that far. Of course, the FTSE 100 not far behind it. What's important to keep in mind is that the FTSE 100 has been on the back foot for the past few sessions. So to see a little bit of a recovery there, not all that surprising, especially in light of the UK CPI data we just got. We'll dive into that in just a moment. On people's minds, though, is going to be the oil story, top of mind, if I will. This chart is really interesting. Brent time spreads starting to see your biggest backwardation level since going back to November. Basically, for the non-nerds out there, what this tells you is that there's a major supply crunch, that physical tightness really manifesting in the markets, which is why a firm like Goldman Sachs, which, by the way, has been very bullish on the commodity cycle, can say in 12 months' time, we will still be seeing $100. That's at least the call from the firm as of this morning. That's going to have a real read-through into what the Bank of England says, specifically when it comes to the inflationary story. Remember, we are seeing a drop in inflation. We can talk about this, too, because you see it in the luxury space as well. Simply that inflation is coming down, but not far enough, and any increase is coming from the fuel sector. The ripple effects here is how are goods really going to be pricing that in if you start to see things, again, get more expensive. That's going to be a topic from around the world, not just the BOE and the Federal Reserve, which maybe Jay Powell mentioned today, but also the BOJ, which is perhaps why you're seeing a little bit more hawkishness when it comes to betting that Ueda just might change his tone. Yen swaps now really signaling the higher rates, people really leaning in to that market narrative. But let's bring it back to the Federal Reserve, because as the one central bank that's reporting today could be setting the tone for the banks in the rest of the week. It is Fed Day. Happy Fed Day to everyone who celebrates. The FOMC expecting to pause while leaving the door open for another increase as early as November. This, of course, comes as the recent oil price rally feeds into fears about inflation. So what better time than right now to nerd out with two of the best. Kim Crawford, Global Rates Portfolio Manager at JPMorgan Asset Management, joins me right here on set, as well as a favorite, Bloomberg Opinions, Marcus Ashworth as well. We had to beg him to come on. Beg him. We had to bribe him, too. And we just wouldn't take no for an answer, would we? Kim, I'm going to start with you, though, because we didn't have to beg you. You get brownie points for that. Let's start there with the Federal Reserve here. They're pausing. What kind of tone does that set for central banks around the world, given that it's kind of a new concept to just pause and stay?
Yeah, so I think the big news that's going to come tonight is really from the Fed's dot plot, right? Are they going to still show that 100 basis points of cuts now that they're near the end of the cycle? We do think they will. I think how they look at how restrictive monetary policy is now is at the real effective Fed funds rate, so the inflation adjusted rate. So I think even though we're going to see their growth forecast move up, then pause at this meeting, I think what's going to be interesting is that 2024 cuts. Are they going? There's some expectation that a cut's going to be removed from there, which I think the market will take on board a bit more with a bit higher yields maybe. But we think, the federal funds rate is going to stay where it is for a while. Headline inflation expectations are going to fall. So the Fed's going to be looking at that rate and becoming increasingly restrictive in real terms over time, and just leave that steady for now.
Well, it's an easier thing for the Fed to map out, for example, because if you look at the BOJ, on the other hand, Wall Street very divergent on what those estimates look like into 2024. A little bit more consensus in the U.S. space, but I'm wondering how that translates to the markets. Marcus, this is your area of expertise. What do yields do after 2 p.m. New York time today?
I think they drop. I think that the market is really primed for a surprise and will take something which is dovish quite strongly. The market sold off relentlessly the last few weeks. It's pushing higher and higher and higher. Yes, there's an awful lot of supply, but that dynamic will get priced in eventually and fully. So we do get something akin to what Kim is saying. I think the market probably will take it quite well. I think most of the bearishness is very much fully priced in.
Well, you mentioned the supply that they're still digesting at the moment. How much of a liquidity problem do treasuries have right now?
Well, they never have, they are the most liquid market in the world. So, yeah, there's no doubt about it. We have potential, foreign central banks selling, which has been going on for quite some while. We've clearly got much more supply coming from the US Treasury. The whole thing together, but I think it's been fully priced in pretty much now. I think it would have to be something very bearish to push the market higher in yields. And I think that's a dynamic which I think would be across all bond markets.
Well, I think what's interesting is, to your point of across all bond markets, is that every bond market is dealing with a liquidity issue. To your point, Kim, hop in here, because when I think liquidity issue, my immediate instinct is maybe that's a market people don't want to touch. As a macro tourist investor, maybe you don't want to touch a market that isn't as easy to get in and out of. Which market? Let's go around the world. Treasuries, gilts, spoons, JGBs, pick your country, if you will, has the biggest liquidity issue right now?
I think it's got to be the UK. And I think that's because we're still recovering from a big volatile period. If you look at valuation at risk models, that volatile period is still in. So just to have the same amount of tracking error in global government portfolios, you're going to be running smaller sizes. Data has also been incredibly volatile. We've seen inflation this morning, big downside surprise. So I think the volatility in the data, plus persistence in UK inflation, and plus that period is it's making that market a bit harder to trade. Not that we're staying away from it.
Yeah. Do you agree?
Partly. I think I'd always say JGBs, Japan, because there is no liquidity there at all. Well, that's because it's a totally rigged market. But there are a couple of dynamics in the UK which Kim's right to sort of point to, I guess. One is particularly quantitative tightening, active sales. Because tomorrow we find out not whether or not the Bank of England does decide to do its last, I think will be its last rate hike, but at the same time whether they increase their active sales along with a natural rise in passive sales over the next year from, say, 40 to 60 billion. Do they also do something similar with the active sales? I sincerely hope they don't. I hope they stop selling very long-dated gilts. It's madness. But nonetheless, if they do go ahead and do it and they flag they'll make the decision, that would make liquidity in gilts, which is already patchy, much worse.
The Ashworth hot take on QT, if you will. But it's interesting that you mentioned that, because I think the strategy is really interesting here. We talk about the Federal Reserve and Jay Powell being the central banker to the world. Is this the moment where Andrew Bailey is setting the tone, perhaps, in tackling QT as actively selling bond markets as opposed to just rolling them off the balance sheet? How much disruption does that create? Well,
David Ramsden's the guy who's really been in charge of this, and I sincerely hope it's not Bailey's style to be setting the charge or anything. I hope they just go along with maybe a very modest increase. And I think really what the Bank of England are trying to do is hide, actually, and get away from. They'll do one last rate hike, a bit like the ECB did last week, and from that they're going to essentially hide behind the Fed. As long as the Fed pauses, the Bank of England probably can put this last rate hike in, 5.5%, and call an end to it, and hope that they can get away with the economy not collapsing into recession, which it still very well might do.
Kim, weigh in here, because Marcus is very, I don't want to say anti-Bailey, but he's gonna give a little.
Love the man.
I know he's gonna give Bailey a little bit of a hard time. It feels like, as a natural critic should. Talk to us though about anything perhaps the Fed, the ECB, by extension, can really learn from the BOE, because I have to say, it feels like from a structural point of view, the BOE has it right in terms of tackling the inflation story far more aggressively. They were the first to come out there, again, preceding even the Federal Reserve. What are the lessons that Bailey can teach everyone else?
So I think you're right. They started the hiking cycle, much sooner than other central banks. They started at a good time. I do agree, however, that at some point they did get a bit behind the curve and a little bit more complacent than other central banks did. And I think that's why we're stuck with slightly more persistent inflation, especially when you look at wages and with a tight labor market. So there are things to learn. I think starting early is important. But yeah, looking ahead to the Bank of England decision next week, it's definitely much more finely balanced now after this morning's inflation print.
Yeah, around the world in 8 minutes for central bank policy. Kim Crawford staying with us. We do, however, say goodbye to Bloomberg Opinion's Marcus Ashworth. We thank you, as always, both for joining us. Coming up on the program, UK inflation for August falling unexpectedly. We're going to bring you the latest for what this means for the BOE tomorrow. That coming up next. This is Bloomberg. Welcome back to The Pulse. I'm Kriti Gupta in for Francine Lacqua. The UK inflation rate unexpectedly fell despite a surge in fuel prices, easing pressure for further rate hikes from the BOE. Let's bring back Kim Crawford, Global Rates Portfolio Manager over at JPMorgan Asset Management, joining me right here on set. Anna Andrade as well, one of our star economists from Bloomberg Economics as well, joining us on the Bank of England. Kim, I want to come back to you because we just spoke to you and Marcus Ashworth about, again, the liquidity of the markets around the world. We talked about the Fed. We talked about the ECB as well, arguably the JGBs. Talk to us about the market plumbing in the gilts market right now.
Yes, so I think one thing, as Marcus mentioned earlier, we're going to get a decision on quantitative tightening. I do think that they are going to increase their active sales and the pace of active sales. I think redemptions are going to rise, active sales stay the same, so the total QT bucket doesn't increase. But I think Ranston has given us enough of a heads up with his speech that we saw a few months ago. And I think what matters more for the plumbing for the gilt market ultimately is how fast is inflation going to fall, how weak is growth going to be, because that will create demand for UK government bonds again.
So active bond sales, it feels like we've waited a while for people to say, we got to ramp this process back up. Anna, walk us through that story. How much disruption do you think actively selling bonds on the open market is really going to create? Or is this something that's kind of we've been here?
Hi, good morning. So what I would say is that the thing about QT is that it hasn't been conducted at this size. There's no precedent for it, essentially. The BOE's line has been that, a gradual pace of QT has little impact in yields. So it kind of assumes that an 80 billion envelope leads to a 10 basis points increase in 10-year yields. And so I think that's kind of, manageable, and that's why it thinks it can do more, because there was kind of a rather successful experience so far. But, we kind of wrote a note where we said, if there's reasons to think that QT has a less impact than QE, because QE was done at times of high market disruption, and it was kind of the surprise part of it that kind of really eased financial conditions. And unlike that, QT is being done in a gradual and predictable manner. So I think there's enough reasons to believe that it shouldn't be too disruptive for the gilt market. Yeah.
On the surface, that all sounds great, but talk to me a little bit about the logic behind this, because it feels like the Bank of England, and we talked about this a moment ago with Kim and Marcus, is simply that they were far out ahead of starting the QT process, but also their rate hikes broadly. They've also arguably been the least successful in terms of their peers in tackling the inflation story. Is this move towards accelerating QT and doing it in a frankly more aggressive manner their way of kind of hitting fast forward on the effects they're hoping to see?
I wouldn't say so. So I think the BOE has been most aggressive in QT. I think one reason for that is that, generally speaking, gilts have kind of a longer maturity than other European peers. So that's kind of why the BOE maybe needs to be a bit more aggressive to kind of unwind its balance sheet. But I would still say that the BOE has been very clear that it wants rate increases, or like the interest rate, to be its marginal tool, and that it doesn't want to signal anything, on monetary policy from a QT. So I don't think the QT is really responding to the surprise, to the big inflation problem that we have. Actually, interest rates are doing the work, and that's why they've come so far and so high.
So interest rates are doing what they're supposed to do. You've got QT getting accelerated. You've got inflation coming down, some good jobs data. Kim, what could go wrong?
What can go wrong? I think if the Bank of England pauses at this meeting, it could go a bit wrong. I think the decision is much more finely balanced now, granted, given the big drop in services inflation, or rather a downside beat to forecasts. But I think the problem is if they get too much confidence from that right now, while they're still staring down the barrel of 8% private sector wage growth. So yes, services inflation is coming in lower than their forecast. The labour market is loosening quicker, but we need to get more confidence that that is going to feed through to wages. So I think they do have to give us a 25 basis point hike tomorrow, and accompany that with more dovish language.
Well, central bankers famously say, look, we're dealing with very blunt tools here. Especially, I feel like it gets even blunter when you talk about wages and when we talk about oil. And that's not specific to the Bank of England. You're seeing that with the Federal Reserve and arguably the ECB as well. How does fiscal policy affect or can affect the wage story?
Yes, so fiscal policy, I think at this point when wages are high and your labor market is loosening but it is still tight, if you have high energy prices and you come in with fiscal policy to try to ease the impact that it's going to have on consumers, that will just create more inflation problems, which is not what we need right now. So I think fiscal policy has to stay quiet. I think we saw, for example, in Mexico, which was an interesting story, where inflation did start coming down, but the new government decided to have more fiscal policy come in, and then you saw much higher yields there. So I think fiscal policy has to stay quiet for now. Monetary policy and interest rate rises are the main thing.
Yeah. Well, you know, I just moved to London from New York, and part of the move was navigating the housing market. And some might say this is the worst time to move to London because of the housing market and how challenging it really is. So if I had a phone call to make to Rishi Sunak or Jeremy Hunt, I know exactly what I would be telling them to do. But Anna, what would you tell them to do? What is the fiscal approach to helping Andrew Bailey at the BOE fight inflation?
I think it's exactly what's been said. It's a tight fiscal stance is what you need right now. I mean, the experience of the past year, or of the winter at least, it's been that, you know, the government was supportive and you know, it supported households with the cost of living crisis and with the energy price increases. And that kind of contributed to, you know, a more resilient economy. We now know that that kind of resilience in the economy actually supported all these second round effects that we're seeing on inflation. So actually, you know, fiscal policy for the time being needs to, you know, be tight so that the BOE kind of achieves its goal of bringing down inflation.
Gold star for the UK government. You don't hear that very often, do you? Kim Crawford, Global Rates Portfolio Manager over at JPMorgan Asset Management, and Anna Andrade from Bloomberg Economics. Thank you both for joining the program. Coming up, NATO Chief Hans Stoltenberg says he's confident the U.S. will continue to support Ukraine in its fight against Russia. We'll bring you more from our interview next. This is Bloomberg.
I'm confident that the United States, as all the NATO allies, will continue to support Ukraine because it will be a tragedy for Ukrainians if President Putin wins in Ukraine, but it will also be dangerous for us. We will be more vulnerable because then the message to him, but also to China, is that when they use military force, when they violate international law, when they invade another country, they get what they want, and that will make us more vulnerable. So it's in our security interest to support Ukraine. And therefore I'm confident that the United States will continue to support Ukraine.
It's not just in the U.S. There is this feeling of war fatigue. Obviously, this would be easier if there was almost a timeline when American individuals and American taxpayers knew there is an end to this. What are you seeing on the ground in terms of the counteroffensive?
So first of all, what we have seen is that the support we provide to Ukraine is making a huge difference. That's the best proof that actually the weapons we are delivering actually reaches the front lines, because we have to remember where we started. At the beginning of this war, many believed, and many of us also believed, that Ukraine would fall within weeks and Kiev will fall within days. We have seen the opposite. The Ukrainians have been able to liberate the north around Kiev, the east around Kharkiv, and then the south around Kherson. And now they are...
At the moment, do you think they're winning?
Well, they are. They are now conducting an offensive. They are gradually gaining ground. We would like to see that go faster. But of course, they are faced with dug-in Russian defensive lines, enormous amounts of mines, and that takes time. But the alternative, not to support them, which will be much more costly for us in the long run, because then we will be more vulnerable for Russian or Chinese coercion and military threats. And therefore, we have to ensure that President Putin loses in Ukraine.
Is there more pressure to strike a peace agreement?
It's for Ukrainians to decide when the time is right to, and when the conditions are right to sit down. So far, there are no indications that Russia wants to sit down and negotiate a just and lasting peace. So if we want peace, if we want a negotiated outcome, the best way of achieving that is to strengthen Ukraine on the battlefield, because that's the only way to convince Putin that he will not win on the battlefield, but has to sit down and negotiate a lasting peace.
NATO Chief Jens Stoltenberg there speaking to Bloomberg's Anne-Marie Hordern about support for Ukraine. Now, New York seems to be the hotspot lately. We have a lot of guests and, of course, coverage coming out of the UN right now. A lot of coverage as well in the IPO market. Instacart, for example, down 4.7% after racking up about a 12% trading debut gain in one of the year's biggest initial public offerings. Now, this is really important, folks, because as we talk about a lot of these IPOs, notice that they are in the tech space. And one of the concerns going into this has simply been, do you start to see this massive rally at the start of their debut only to have it paired and you really go negative in the months that follow? It's been a pattern you saw for Airbnb, for DoorDash, and among other corporate names as well. Does it then extend to non-tech focused IPOs? That's going to be the question moving forward. Right now, Instacart down 4.7% in the pre-market. Coming up on the program, we go right back to the geopolitics. EU-China trade tensions increase. Commission President Ursula von der Leyen says massive Chinese subsidies for EVs warrant an investigation. That story next. This is Bloomberg. Pound falls as the UK's unexpected drop in inflation opens the prospect of a pause from the Bank of England tomorrow. Stateside, the Fed is expected to take a breather on hikes for the second time this year, while leaving the door open to another increase as early as November. Plus, Europe's car sales jump as Brussels starts probing China's EV subsidies. More from our interview with European Commission President Ursula von der Leyen in just a moment. Good morning and welcome to The Pulse. I'm Kriti Gupta in London. We are getting some headlines here from the energy space, if you will. Total Energies to invest $300 million in JV with Adani's Green unit. It looks like Adani Green says Total will hold about 50%, with the company remaining in JV's name. What's interesting here is simply that you are starting to see that diversification from a lot of these big oil companies around the world into the green space. And it's also interesting that there is appetite to do that through the Adani empire, which, of course, we know a couple of months ago was not as much in favor. Right now, both stocks down by, we'll call it 1% or upwards of 1% for Adani, about 2% for Total Energies. Sticking with the broader macro space, European Commission President Ursula von der Leyen has told Bloomberg the EU needs to investigate China's massive subsidies for EVs. She spoke to Francine Lacqua.
We like competition, but it has to be a fair competition. And we want a level playing field for our companies. And what we see is massive subsidies in the EV sector in China, which is, of course, unleveling our playing field. And we do not accept this in the internal market for our companies. So we do also not accept it for Chinese companies. And therefore, there is the investigation now into subsidies in EVs in China.
Have you, since actually announcing the investigation, talked to Chinese officials?
Yes, we are, of course, in constant contact. The executive vice president will travel to China and discuss it also with the Chinese. But we have now to look at the figures, and we're moving on.
In the past, there was always a tit for tat, some kind of retaliation, or certainly China making noise back. Will that happen?
Well, this we'll see. But important is that for us it's very clear. We want competition. We want competition on quality, cost effectiveness, but not on subsidies. And therefore, this is something, as I said, we would not tolerate for our own companies within the single market. So it has to be fair play.
European Commission President Ursula von der Leyen there speaking to our very own Francine Lacqua. Meanwhile, fresh data this morning shows August car sales in Europe surged by 21% year on year. EVs driving a lot of that growth in new car registrations. This as the European Commission seeks to launch an investigation into Chinese EV subsidies. Bloomberg's Oliver Crook joins us now for more on the story. Ollie, let's start with the data there. What did we learn? What do we know?
Right, Kriti, this is another monster print for European car sales, up, as you say, 21%, and really just capping what has been a 13-month run of just really strong sales here in Europe. The concern is, however, that the back half of the year may not be quite as rosy. You have sort of the consumer maybe weakening a little bit. They've worked through a lot of the demand that they've had in the backlog, and also you're going to get a tougher comparison year on year because the back end of 2022 is when things started to really pick up for the sales, so less flattering comparison. When you look at the EVs, things get kind of interesting. EV sales in Europe doubled in the month of August. They also accounted for more than 20% of all the cars that were sold in Europe in August, which is the first time that that's happened. And they've also overtaken diesel sales by quite a margin. But what's interesting is with all of these fears around Chinese EVs, they only hold about 5.6% of the European EV market. If you want to talk about some interesting numbers, look at Tesla's numbers this year. Sales are up 145%. In the month of August, Tesla sales were up 250%. And when you look at market share, the Tesla Model Y was not only the best-selling EV in Europe for the first half of the year, it was the best-selling car, and it commands 13% of all of the EV market here in Europe, which is more than all of the Chinese combined times 2.
Well, at its core, though, it's a story of competition. At the end of the day, China, the leader in electrification worldwide, I suppose it only makes sense that the EU wants their fair share. Something that gets in the way of that, though, is going to be margins. It's going to be wages, which brings us to our next story. United Auto Workers making a truly international, I want to say, debut on their stage. They're having pretty wide ripple effects. What do we know about the latest in the U.S. and Canada?
Completely. Everyone is watching this very, very closely. And where we are is that basically there has been no concrete motion forward. We know that we have a deadline from the union, Friday noon. They need a substantive offer by then. Otherwise, they're going to expand the strike. We don't know if that means slightly or that means bringing the big three to paralysis. All of the options are on the table. That has been their strategy from the beginning. In terms of how this is actually affecting the auto players, Stellantis says they're fairly well insulated. They have taken action to sort of get inventory to offset what they're losing. However, some dealers are saying they're starting to see inventory come down, and S&P Global Mobility says that this is costing the big three about 3,000 cars a day in terms of production. The White House team has not yet arrived in Detroit. We know that we were expecting that sometime this week to help facilitate the talks. And really, though you have stalemate in the U.S., you do have some breakthroughs over in Canada. You mentioned that Ford and the union there managed to reach an agreement. The contracts expired on Monday night. They have a tentative agreement. That means that 5,600 workers will not strike, so at least some dialogue going on between the big companies and the unions.
Well, they do say that Canadians are more friendly than Americans. Bloomberg's Oliver Crook all over that story. We thank you, as always. We're American. We can say that. Let's bring you some corporate news now and stick with that theme. Amazon planning to hire 250,000 logistics workers ahead of the holiday shopping season, a jump from last year's quota. The online retail giant will also boost average pay for logistics workers amid a U.S. labor shortage. The announcement comes even as some analysts expect overall holiday hiring to stay muted. Sticking with tech, I guess we can call it, Disney shares falling after it said it plans to nearly double its investment in its parks and resorts division to $60 billion over the next 10 years. The world's largest theme park operator says it has over 1,000 acres of land that it could develop and cited increased profits in recent years from investments in rides, cruise ships, as well as other attractions. Disney says it's seen record growth in customer spending at parks over the past 2 years. Coming up on the show, we go from the corporate space back to geopolitics. In the conversation in New York, Poland's president talks to Bloomberg about the intensifying dispute over grain that's shaken his previously strong relationship with Ukraine. That conversation next. This is Bloomberg. Conversations that matter and the insights you need. This is The Pulse. I'm Kriti Gupta in London. Russia's invasion of Ukraine and the perils of climate change dominated early remarks at the UN General Assembly's annual debate. President Joe Biden has urged world leaders to continue backing Ukraine, even as the country and its allies brace for the prospect of a long-term conflict.
Russia believes that the world will grow weary and allow it to brutalize Ukraine without consequence. If you allow Ukraine to be carved up, is the independence of any nation secure? I'd respectfully suggest the answer is no. We have to stand up to this naked aggression today and deter other would-be aggressors tomorrow.
Meanwhile, the Ukrainian president has told the General Assembly that Russia is committing genocide in his country. Vladimir Zelensky says Moscow is weaponizing food and energy. Earlier this year, Russian forces attacked a nuclear plant in Ukraine and more recently moved to restrict Black Sea grain imports.
Russia is launching the food prices as weapons. The impact spans from the Atlantic coast of Africa to the Southeast Asia. And this is the threat scale. And I would like to thank those leaders who supported our Black Sea Grain Initiative and program Grain from Ukraine.
Now, Poland's president says his country will protect its market from the influx of grain from Ukraine. Andrzej Duda has also urged Ukraine to refrain from public attacks in a dispute over grain that's shaken ties between the key allies. He spoke with Bloomberg's Anne-Marie Hordern.
We have sacrificed a lot. We have given a lot in order to help Ukraine, and we want to assist Ukraine because we understand what it means to be placed under Russian aggression. But we also need to protect our citizens.
Polish President Andrzej Duda there speaking about the conflict in Eastern Europe. Let's bring in Will Kennedy, Bloomberg Senior Executive Editor for Energy and Commodities. Will, a lot to digest in the commodity complex here. I want to start with the grain story because it feels like after this idea that Ukrainian exports of grain, the world basket or the grain basket of the world, after it started being attacked by Russia in the ports, the grain deal eliminated basically, brokered by Turkey, it's something that's priced into the grain market. To what extent is that true?
The grain prices continue to slide. They had a blip up when those attacks first happened and the grain deal fell apart. But they have been sliding and they are pretty low and certainly much, much lower than they were after the war started. Now, that's a problem in several respects for Ukraine. Ukraine has, in fact, had a very, very good harvest, and harvests generally have been good around the world. But Ukraine's problem, obviously, is getting that to market. Now, those Danube ports, which Russia is attacking, is one way, but the other way has been through Eastern Europe. And that's where the tension with Poland arises. The farming community in Poland is a very important constituency for the governing party facing elections. And those Ukrainian grain exports through Eastern Europe are depressing prices. So there's a real source of tension there.
And building, by the way, should we say, decades of tension between Poland and Ukraine as well, only united via the conflict with Russia. Talk to us a little bit about the ripple effects there. If you start to see this kind of weakness in soft commodities, how long does that last?
Well, if we think about Russia, of course, is the world's biggest grain exporter. It is looking like have a very, very healthy harvest again this year and export record amounts of grain. So Russia is benefiting hugely from this. Prices aren't great, but its exports are rising as Ukraine's exports fall. So it is doing okay, whereas Ukraine is finding it very hard to export grain and then not getting great prices when it does so. So for Russia, they're able to exert this pressure on Ukraine by ripping up the grain deal, by bombing its grain export ports, but benefit itself and, importantly, not antagonize its allies in the southern hemisphere because grain prices are affordable for most buyers right now.
Where does that grain go exactly? Because, of course, we know they're competing with the United States as well in terms of harvests. Is this the grain that goes to Asia?
Most of the biggest buyers of Russian grain historically are in the Middle East. Egypt is the world's biggest grain buyer. Other Middle East nations buy a lot of wheat, but Africa and to Asia as well.
Yeah, the bread belt of northern Africa. Of course, we know that was a big part of the Arab Spring, I believe, several years before. Let's switch over to oil, though, because that, of course, is a connected story. What is driving oil prices right now? Where's the tightness coming from? Is this purely the Saudis?
It's definitely led by the OPEC Plus coalition. Saudi Arabia has made big cuts, that million-barrel-a-day voluntary cut. Russia has made some modest cuts to its exports, and importantly, they've extended that to the end of the year. And coming against what is a demand picture which is much more buoyant than people might have predicted a few months ago, those restrictions to the end of the year, restricted supply, strong demand, and you've got the price valley that we see.
How much pushback do you think the OPEC Plus members are actually going to get, given that originally I think, justification for originally doing this was to bring back their break-even prices back to a level where their national budgets weren't in deficit anymore. Now we've gone way past that point. Even Goldman Sachs talking about in 12 months a $100 price target on Brent. Where does the pushback come from?
Well, if we look at it from the perspective of OPEC Plus, I think they feel that this is a fair price because their dollars are not worth what they are today, what they were a few years ago. They're grappling with a world in which the things they're importing are more expensive, and they feel that they need a higher price, and it's fair that they have a higher price to maintain their purchasing power. That's the first thing to say. Where the pushback comes from is an interesting question. Obviously, $100 tends to be a pain point for people, or an obvious point for people to focus on. And on top of that, you've got a very stretched oil refining system around the world, which means fuel prices have risen further still. So we are starting to see those prices feed through to consumers, and for that it could cause discontent in major consuming countries in Europe, in the United States, in Asia. So the equation for OPEC Plus is how far they feel able to push it. At what point does it, A, start to make things too difficult for them in their relationships with their allies, and B, that they may see some demand destruction. And I think that's what the market will be seeking to find out in the weeks ahead.
Plus, of course, the bottlenecks in the refined product space, which you alluded to as well. A fascinating time to be Executive Editor of Energy and Commodities. Will Kennedy, we thank you as always for joining the program. Let's go back to the UK now. Rishi Sunak facing a backlash among conservative MPs after the British Prime Minister said he would roll back some of the green energy policies, all while continuing with the country's 2050 net zero target. It's thought Sunak could defer a ban on new diesel and petrol cars by 5 years to 2035, but the government hasn't yet made that decision public. Opposition parties are also trying to capitalize on the government's environmental policies. Speaking with Bloomberg TV's Francine Lacqua in New York, London Mayor Sadiq Khan says the Prime Minister is proving weak on the climate crisis.
The response of governments should be actually to turn this awful crisis into an opportunity, creating green jobs, a Green New Deal, thinking about how we can both save the planet, address climate change, but also give people security and have that just transition. And this is basically, lazy politics from a weak Prime Minister throwing red meat to his backbenchers because he's so weak and ineffectual.
Mayor of London Sadiq Khan there speaking to Bloomberg in New York. Now, coming up on the program, we preview the Fed's rate decision today and whether Jay Powell will leave the door ajar to further rate hikes in the battle to tame inflation. That conversation next. This is Bloomberg.
What's the biggest transformation happening in beauty is what we call beauty tech, is the help of technology to augment the performance of beauty products, either through diagnosis or through even personalized made-to-measure beauty products. And that's probably the future of beauty. Indeed, we use AI. We use AI to augment our researchers, to invent new ways to formulate products, to go faster. We use AI to provide the best advice to consumers.
Color matching.
Color matching, skincare. Skincare diagnosis is very important. In the end, consumers are passionate about beauty. Beauty is the #1 topic of conversation on TikTok, for example. It's something that passions people, but it's a jungle out there. There's so many products, so you need to help people choose. So curation is a very important part, and to help people make the right choices, you need some sort of either diagnosis or virtual try-on so that they see which shades are going to fit better. Same for hair. So technology is a great help, not only to create new products, but also to make consumers happier about the products.
You can, of course, watch the full interview with Leaders with Lacqua Goes Green, airing at 9:30 p.m. New York time tonight in the U.S., and then at 6:30 p.m. London time on Thursday. Now back to our top story. It's a major week for central banks with the Fed's latest rate decision due at 7 p.m. London time. The FOMC largely expected to pause, perhaps leaving the door open for another increase as early as November. Let me just take a moment to emphasize just how big the consensus is here. The big number I bring you, 5.5%, the percent of estimates in a Bloomberg survey predicting a rate move by the Fed, which tells you everybody is in the camp of saying they're going to pause this time around. Let's see if there's any surprises. Who better to ask than Bloomberg's Valerie Teitel joining me right here for a preview. Valerie, any surprises?
It's all going to be in the dot plot, frankly, Critty. Just how much higher they shift up that 2024 dot. And on the flip side, on the dovish side, do they keep that threat of an additional hike this year still in that dot plot, in that 2023 terminal rate? The consensus lately, the market discussion lately is really focused on those 2024 dots. Some say that to get a hawkish reaction from the market, it'll have to shift up higher than 25 basis points. And Critty, the slope at the moment between the dots, the 2023 dots and the 2024 dots, as you can see on the screen, does imply 100 basis points of cuts before year-end 2024. If Powell does want to give a nod to the recent economic strength, in some way allows him to cast some doubt on the downward trend of inflation, on the recent softening of the labor market, he would shift those dots higher in a bid to convince markets that there are no cuts on the horizon, that he needs to see a growth slowdown in order to trust inflation's downward trend.
I've always been a little curious about who invented the concept of a dot plot. It feels a little easy, I guess, unless you're actually doing it. Valerie, talk to us about the oil story, the wage story. Do you think Chair Powell's going to mention it today?
These are a few risks people have been talking about recently. Obviously, the upward trend of oil has caught many by surprise, leading us to ponder if there's going to be another resurgence in headline inflation. But I think Powell is going to take the opposite side of that view and think that this rise in oil prices is going to dent the consumer more than ignite inflation. We know that growth has started to turn. The consumer story has started to turn a bit weaker. And perhaps if they're spending more of their disposable income on filling up their gas tank, they're going to be out spending less on other things elsewhere in the consumer sphere. So that may be something Powell acknowledges. There has been a lot of doubts on the consumer lately, whether it's the student loan repayments resurging, coming back this month, or in fact, that rise in oil prices. There might be some other risks on the horizon that Powell could point to, Critty, one of them being the imminent government shutdown and the auto workers union strike.
Yeah, a lot on Chair Powell's radar. Valerie Teitel, thank you as always for walking us through that. Of course, you can see that rate decision full coverage here, 7 p.m. UK time. I want to quickly get you some headlines that we have just crossed the Bloomberg terminal. Chevron and the Australian unions failed to reach agreement after their talks. Of course, we're watching the labor story around the world, but it looks like this certainly not going in Chevron's favor. Another major mover this morning, UniCredit, planning to start a €2.5 billion tranche of its 2023 share buyback program on the back of some pretty high capital levels and robust financial performance. Those shares higher by 3.8% already, one of the best performers this morning. Coming up next, Bloomberg Brief with Manus Cranny in New York and Danny Berger in London, setting you up for the New York trading day ahead. Stick with us. This is Bloomberg.